Today we're going to talk about the loan origination and loan servicing numbers for the month of December, and then talk about the investor numbers for November. Reason we go back 1 month prior on investor numbers is because we just don't have those investor figures available at the moment. In most cases, the investor figures are made available usually mid-month of the following month. So we should have those figures available for the month of December, right around January 15th to the 20th. So in this presentation, I'll go over some announcements about the fund. We're going to go do a quick overview of the fund, so those that are not invested in the fund can get a brief overview of what you're investing in. And then I'll share some of the fund updates from loan origination, loan servicing, and investor relations. Provide a quick market update, both nationally, California, the state, and then locally here in San Diego as well, and then respond to some of the common questions that we are getting from investors. I just want to first start off, talk about what's going on in Los Angeles. Obviously, our hearts and prayers go out to those that are impacted by these terrible fires in the city of Los Angeles. We hope everybody remains safe and that they can extinguish the fires quickly. We are, though, getting a lot of questions about our exposure to the Los Angeles market. I did send out a quick email yesterday about that. So we've got pretty limited exposure to the LA market. I think less than 7% of our loan portfolio is actually in the LA basin or in the LA market. We've reached out to all of our borrowers out there. We've looked at where the location of the properties are for the properties that are securing our loans out there, and we have not been impacted in any way at this point. So number two, common question again is, well, what are our fire insurance requirements or fire insurance requirements? The answer is we do require property insurance, including the fire coverage on every one of our loans. That is part of the procedure in closing the loan to ensure that we are covered. Minimum coverage is either the current value of the property or the balance of our loan. Servicing procedures, we do review or we do audit our files for every one of the properties that are securing our loans. So we both have servicing procedures that happen monthly to ensure that those policies are active, and then we have audit procedures as well that we do randomly go through files to ensure that the insurance policy is active and that we are the named insured on that policy. And if worst case scenario occurs in which the borrower does not maintain that insurance policy, we do have processes in place to purchase a forced placed insurance, which will cover or insure the asset that our loan is secured on. So again, our thoughts, prayers go out to those that are impacted by the fires in LA, but I'm relatively confident that it will not impact our loan portfolio. All right, let's talk announcements. The fund returned a 9.69% yield to the investor in November, so had a very, very strong month of November. In fact, one of the metrics that we do use, or I do take a look at, is what is the percentage of capital outstanding as a percentage of total investor capital, and I think we were able to stay above 98% of total investor capital deployed. So that's a great number to be at. We obviously want to ensure that our investor capital is always deployed and always earning a return. Bullet point number 2, funded 14 loans in November, totaling $12.63 million. So that's right in line with kind of what our goal was for 2025 on a monthly basis. The team was busy all the way through New Year's. I think 10 of those 14 loans closed between Christmas and New Year. So give a big pat on my back to my underwriting and loan closing team to getting those loans across the finish line. We ended the year funding $133 million in loans. That is by far the largest year or total amount we've funded in a given year. probably doubled that from last year. So congratulations to our loan origination and underwriting team for identifying and underwriting those loans. Portfolio remained at 94.12 million. So we had a good balance of new loans being added to the portfolio and also loans that are getting paid off. We anticipate already January is already a busy month. And so I fully anticipate that the portfolio will jump above 100 million by the end of January. We added 3.5 million in new investor capital in November. So I think we're close to 94 million in total investor capital. So money continues to flow into the fund, which is good. Allows us to expand the portfolio of loans and continue to drive new loans. And then lastly, I'm going to touch upon this later in this presentation, but we are organizing that investor summit. We've scheduled the date, April 26th, here in San Diego. For those that are not aware of the investor summit, essentially what it is, it's a full day event that we're bringing investors in. Not only get a chance to meet the team, but you'll get a chance to meet some of the vendors that we work with. And then we're also bringing in industry experts to speak in one-on-one panels. We'll also be hosting a lunch and dinner and cocktail hour. So giving again an opportunity to meet some of the other investors in the fund, and then also meet some of the team members. All right, for those not familiar with TaliMar Income Fund, let me give you a quick brief overview of it. So TaliMar Income Fund is a private debt fund. Essentially, we fund short-term loans for real estate investors, primarily investors that are buying residential, multifamily, single-family and multifamily properties to renovate them and either sell them or hold them as long-term rentals. These borrowers come to TaliMar Financial for their loans because in many cases, your traditional bank isn't going to fund these kinds of loans. They're too risky and or they're too short term. Current portfolio consists of 102 loans, totaling 94.12 million. All the loans in the portfolio are in first position. An average loan to value ratio of the portfolio is approximately 62.5%. Blended across the portfolio. We do not have any non-performing loans in the portfolio as of today. Investor returns as of November 31st, year-to-date return is 9.52%. So a very good, healthy return for a portfolio loans secured in first position. Fund consists of 321 investors with a total invested capital of 93.2 million. It is a Reg D fund, so it is a private placement offering. We did structure it as a REIT, so there's significant tax savings for those that invest non-retirement funds. And if you're retiring investment funds, or if you're investing retirement funds, just keep in mind that you can invest through Charles Schwab or Fidelity if you are a customer of theirs. All right, so let's jump into loan origination for December. As I mentioned earlier, the team was busy. We funded 14 loans totaling 12.6 million. Again, right in line with kind of what our goal was on a monthly basis. Blended interest rate of those loans that were funded were at 10.48%. Kind of a slight decline from what we've been doing in the past, but it is getting fairly aggressive out there in the private lending market. We've seen a lot more institutional capital flowing into the market. So we got to remain competitive on the rates that we're lending at. Average loan size was at, actually it's not 1.5 million, it's about 990,000 was the average loan size. Average loan to value ratio, 63.37. Average loan term was 14 months. Loans funded per month. So this is what this graph shows is how many loans that we're funding on a monthly basis. We try to target between 10 to 14 loans per month, being that the average loan is around 900 to $1 million. That's about as much investor capital that we have. And then also kind of the resources that we have internally allows us to really kind of be funding between that 10 to 14 loans per month. So we are on the higher end of that, right at 14 loans in December. Balance funded per month. So as I mentioned earlier, about 12 million per month. So that's just kind of right in that target range or our goal on a monthly basis to be funding. And the reason 12 million is kind of that bogey figure that we've selected is essentially that's a good number where we have enough loans that are paying off that we can recycle those paid off loans into new loans, and then also take in new investor capital and get it moving or get it working as soon as possible. Average interest rate, we're still staying pretty, pretty average right here in that 10.5% range. We were slightly below about 10.48%. Now, I anticipate being between 10 to 10.5 going into 2025. We're still seeing a lot of new investor capital coming in, competing with our capital. So we got to stay relatively aggressive in what we're pricing. And I don't see really that changing in 2025. We did see a slight increase in the 10-year Treasury today, though that isn't a direct, doesn't directly impact what we charge in terms of our rates. It does impact what our competition is borrowing money at in order to lend it at. So that's, it's a loose correlation to where the 10-year Treasury is. This is an example of a recent closing that we funded. This one was here in San Diego. It was a fix and flip loan. So essentially a fix and flip loan, from our perspective, is a loan where we're going to fund a portion of the purchase and then fund the renovation costs as well for our client. So this was a single family home here in San Diego. We priced the loan at 10.25%. This is a repeat borrower. I think we've done 5 to 7 loans for this borrower, so very seasoned. Loan size was $645,000. This was on the higher end in terms of loan to value ratio, but due to the borrower's experience and then also credit, he was able to qualify for the higher LTV ratio. All right, let's talk loan servicing and our loan servicing portfolio. So currently, a loan servicing portfolio consists of 102 loans totaling $94.12 million. As I mentioned earlier, I anticipate that we are going to be going or increasing that portfolio size over 100 million by the end of January. Average rate or blended rate across the portfolio is about 10.64%. We distributed actually $670,000 in interest income last month. So that is the largest amount of interest income that the fund had earned in any given month. We received 8.69 million in payoffs, so roughly 9 million in payoffs. So when you add that to that 3.5 million in new investor capital, you're getting close to the 12 million mark, which is a good balance between loans that we are originating and payoffs that we're receiving. And then we have 0 non-performing loans in the portfolio. So we ended the year actually with 0 NPLs in the portfolio. Congrats to my loan servicing team for staying very vigilant on servicing our loan portfolio. So this graph shows the number of active loans per month. So as you'll notice, that has steadily increased since this time last year, where we were at 80 loans in the portfolio, that we're right at about that 102 loans in the portfolio. What this table shows is the outstanding balance per month. So again, we've got a good steady increase in the size of the portfolio. We're usually on average increasing the size around 2 to 3 million per month. So this is kind of where you're at right now. Started the year at about 65.5 million, ended the year about 93 million. This table shows the interest income received per month. And what you'll see here, again, is I wouldn't say a steady increase, but over a long term, over December, between this time last year, you've seen a steady increase, but it's jumping around. And this is really predicated based upon the amount of investor capital outstanding that month. What this table shows here is the principal payoffs per month. So as obviously that portfolio grows, we see a larger influx of payoffs. But we're usually averaging between 7 to 10 million is about what we receive in payoffs per month. What this table shows is our loan balance by county. So this is the active loan portfolio. And you'll notice that a vast majority, almost 80% of our loan portfolio is here in San Diego. Obviously, I've been here doing this for 15 years, so we're pretty entrenched in the San Diego market. We are looking to kind of expand our exposure into the Orange County, LA markets, being that number one, they're just bigger markets, but there's an opportunity there in those markets to grow our portfolio. But that being said, again, the vast majority of our portfolio still remains here in San Diego. What this table shows is the percentage of the portfolio by asset type or property type. So again, vast majority of our portfolio is secured on single family 1 to 4 units. I anticipate that's going to remain like that for the foreseeable future, being that we're really focused on funding single family and multifamily properties. But we do have a mix of properties that are securing our portfolio. What this table shows here is the loan type as percentage of active portfolio. So again, we really primarily fund 3 loan types. You got your fix and flip loan, where we're financing a portion of the acquisition in the renovation costs for the client. We're distributing those renovation funds to the client over the course of the project, usually in 5 to 10 draws. And then the client is usually taking us out with the sale of the property. That may differ from what we consider our kind of traditional bridge loan, where there's no real value add to the bridge loan. The borrower isn't adding value. There isn't a construction budget to it. And then approximately 22.6% of our portfolio, or 22.7% of the portfolio, is secured on new loans with new construction. What this slide here shows is actually a recent payoff. So this is an example of a project, a fix and flip project that we funded. This was in El Cajon. The loan size was $805,000. Client acquired the property, renovated it. We provided the renovations funds for the client. As they got work done, we dispersed those renovation funds to the client. Duration of the project was 5 months. Final loan to value ratio was at 70%. Interest rate at 10.5%. And then the exit strategy here was the sale of the property. This has kind of been our bread and butter loan since I first launched the company back in 2008. I like fix and flip loans because borrower is adding value to the property. There's a clear exit strategy. Vast majority of these borrowers are seasoned investors, so they've got experience and they have strong credit. The only downside to these loans is they are shorter term, so you're constantly having to recycle through these loans, meaning that this loan is only 5 months outstanding. When that pays off, you're always finding the next loan that you need to fund. But there are plenty of homes out there that are in need of some TLC. So our clients are constantly finding new deals for us to fund. All right, let's go jump over to investor relation. So as I mentioned earlier, our fund currently has 321 investors, totaling $93.2 million in total investor capital. The fund grew by $3.5 million between October and November, through November. We have earned a 9.6% annualized yield in November, which brings us to 9.52% annualized year to date. We should finish out the year right at that 9.52 to 9.53% range. And we distributed $732,000 in total investor capital to investors in November. All right, so let's share this chart. This is the number of investors per month. As you'll notice, we do have a steady incline from December, so this time last year, through December 2024, usually adding about 10 new investors to the fund approximately every month. Total investor capital by month, again, we grew by $3.5 million. We're usually growing about $2 to $4 million per month is kind of our
our bogey right now. That allows us to be comfortable that we can deploy that new investor capital through or with our loan origination team. So we started the year right in that kind of 65 million, and we'll be ending the year in about 90. I'd say we'll probably end the year around 95 million. All right, so I did market predictions in November for 2025, or excuse me, for December 2025. So I'm going to keep this slide up here, and I want to see how correct I am by the end of 2025. So my predictions were this: home prices will rise by 4%, essentially by inflation in 2025. I don't think you're going to see massive uh, spikes in home values, nor do I think you're going to see any decline. I think if you were to look at the economic numbers that were posted today, job starts or job numbers were good, unemployment remained low, and in fact, the um, I think that the people playing the market were probably pretty surprised of how strong the economy actually is. So I think you're going to see that in the in the housing market, and I think values are just going to essentially rise by inflation. Mortgage rates will remain near 7%. I don't think you're going to see rates go anywhere this year. There's still discussion. Is there going to be some rate cuts by the Fed? I just can't see why they would be cutting the rates right now with the economy doing pretty well. Number of homes listed for sale will increase by 10%. I think you're going to see more and more homes listed on the market for sale. And I think people are just feeling that, you know what, it's maybe time to sell, relocate. Interest rates aren't going down. They're not going to wait. And they're going to prefer to go move somewhere else, even if they're paying a little more for their mortgage payment. Rents will remain flat in 2025. I think we've taken rents as far as we can. AI will result in consolidation in the industry. AI is coming at us very quickly. We're seeing it everywhere in the real estate industry, and I think it's going to have a considerable impact on um, how things work in the real estate industry. And then I also think urban centers will continue to adopt pro-growth strategies. I think they'll continue down this path with being more flexible on accessory dwelling units. I do think that there's going to be some community pushback on ADUs, but but I think that, with the need for new housing, that's going to trump the community concern about accessory dwelling units. So we'll see what happens. We'll continue to talk about this through the year. All right, let's jump into the housing numbers. So what this slide is showing is the numbers nationally for housing. I'm not a big proponent of looking at housing nationally because housing is a very market by market number. So, but let's just take a look at from nationally what's going on with housing. So median home prices jumped 5.4% from this time last year. I think that's going to slow down. In fact, that number was closer to 7% last month. So I think you're starting to see home values really starting to come down, or increases in home values coming down. Number of homes sold up 5.2% to 385,000. Again, that's pretty close to what last month's number were. Remember, these numbers are compared with this time last year. And I think you're going to see the number of homes, I think, are going to continue to increase uh, throughout this year, just simply because there's going to be more supply on the market. I think there's going to be more people coming on to sell their market, which just kind of gets us to point 3 is number of homes for sale. That jumped by 12% this time from this time last year. And more people are listing their homes, which should increase the number of homes sold. Now, what that's going to impact is the next slide, or next point, is days on market. I think you will see an increase in the number of days on market. You really kind of want to see it right around 45 days. That's a good, healthy balance of homes coming to the market and then the number of homes sold. Anything higher, that kind of shows that the market might be getting sluggish. So we did see a pretty big jump in the number of days homes sat on the market. We saw it year over year by 6 days. So we'll keep our eye on that number. Months of supply seemed unchanged at 3 months. So usually you want to kind of keep that number of months of homes on the market below 4 or 5 months. And then fixed rate mortgage was actually down 0.64% to 6.8%. rates are still kind of in that 6.5 to 7% range for those that maybe remember the 70s and 80s where rates were north of 10%. This may not seem so bad, but if you're younger and you're used to rates in the sub 4% range, this might look bad to you. But you know what? I'm not concerned about the mortgage rates in this range. So what this slide shows is where are people moving to in the United States and where are people moving from. On the left side, these are where people are moving to, and I was surprised. Sacramento was #1 on that list. You know what? I honestly think it's just people moving out of the Bay Area and Los Angeles, moving to kind of a cheaper area of California, being Sacramento. You got Florida there, South Carolina, Maryland, and we're going down Nevada, Florida. So these are states, though I was surprised to see Hawaii has made the list. So top 10 places where people are moving to. They're getting off the mainland and heading to Hawaii, probably for the good weather. And then where are they moving from? Where are they moving out of? Well, it's no surprise. Los Angeles, New York, San Francisco, Seattle, Washington, Chicago, Philadelphia, Dallas. These are surprising down here, Dallas, Denver, and Boston, but people are leaving urban markets looking for more rural areas. So that's what people are moving out of. All right, let's look at the California housing market. Median sales price up 4.2% from this time last year to 827,000. That's an astronomical number if you're trying to be a first-time home buyer here in the state of California, and this is why we have such a housing crunch. Just not enough homes available for people to purchase. Number of homes sold up 12%. So you did see a big jump in homes, though only 21,000 sold in November. That's for the entire state of California. So that's like near zero homes as a percentage of total homes in California. Number of homes for sale, that did jump almost 20% from this time last year. Now the media will kind of highlight this number, how number of homes have listed on the market have spiked, but you're literally coming from no homes on the market to maybe some homes to the market. So I wouldn't be too worried about seeing that that increase in the number of homes that are being listed, because we were at all-time historic lows. Days on market jumped 8 days to 39 days. So as I mentioned, you kind of want to stay around that 45 days is kind of a healthy number. So we're below 45 days, but we'll keep our eyes on that. You kind of see where that number ends up here over the next quarter. And then months of supply, no change. We're still looking at about a 3-month supply. You want to stay between 4 or 5 months to make it, or to ensure that there's a healthy supply on the market. Top 10 metro areas in California with the fastest growing sales price. Look at that. Glendale, Orange, Arden, Arcadia, Richmond. So we've got LA markets and then into the Bay Area markets as well. So here are the markets with the fastest growing sales price. So if you're in Glendale, you are a happy camper that you own a house there. All right, let's get it really down to the San Diego market. Home sale prices have increased by 3.2% from this time last year. So that's actually below national numbers and California numbers, which was actually surprising. But if you were to look at the graph actually between this time last year and today, you actually did see this big hump where it spiked and then has come down considerably. So that's why we're only at that 3.2% mark. Number of homes sold did jump again 10% to 721. That's crazy low. So only 721 homes sold in the entire county of San Diego. Number of homes for sale did jump 25%, so a little higher than what the jump was in California, to 2,700 homes for sale. For how many people in the state of California? In the county of San Diego, 2.5 million. So still, the number of homes remains very low as a percentage of the total homes available in San Diego County. Days on market, it jumped 15 days. That's a huge number of jump. Can you imagine this time last year, homes sat on the market for only 15 days. I mean, you had to put an offer in before you went to go see the house to even get a chance to have your offer accepted. So buyers now have a little more time to actually look at the house and make a educated decision if they want to buy that house or not. And then months of supply, we're at 3 months. So where are people moving to? People moving to San Diego from where? Well, people are coming down from Los Angeles and San Francisco. Those from the Bay Area, I think it is a steal living down here in San Diego. I think you're seeing a little less of that though. From what I can gather in the market and talking to agents here in the San Diego market, you're seeing fewer and fewer people relocating from the Bay Area. DC, Texas, Seattle, New York, people are relocating from those areas into San Diego. If you're sick of San Diego, you are moving to Las Vegas, Portland, and Nashville. I don't know why you'd be moving to Las Vegas. I have no problem with Las Vegas. I enjoy it on the weekend, but it can get hot out there. But I get it. Taxes, no taxes, can't really impact the decision of where you move. Up to Portland, Oregon, people are going. Nashville, Tennessee. I actually had an opportunity to spend some time with a couple, my wife and I, with another couple from Nashville. They just loved it out there. They can't say anything better about Nashville, Tennessee. Phoenix, Boise, and again, Hawaii. People are moving out to Hawaii. So I think the only other place with better weather than San Diego is going to be Hawaii. All right, so want to make some more announcements. I am excited about this. This is our Investor Summit. What is the Investor Summit? It's an opportunity for all of our investors to come in for a full day of meeting the team, networking and meeting with other investors, and meeting with our vendors. We're also going to bring in industry experts. And essentially what's going to be all day, 1-day panels. I'll be doing some question and answer sessions with some of our vendors to talk about kind of what's going on in the mortgage fund industry and kind of in the private debt industry. April 26, 2025, where we have some ideas of where the location is going to be. It's definitely here in San Diego. We just have to identify the space. Cost is going to be free. So if you're an active investor in the fund, this is going to be free to you to attend. If you're not actively invested, I think the fee is $250. But we do have limited space. I think we're limited to 150 people to attend. So if you're interested in attending, we're sending out an email, kind of a pre-RSVP to see kind of what the numbers are going to look like. So active investors are going to have preferential treatment. If you have any leftover spaces, those will go to non-active investors. If you're interested in learning more about the Investor Summit, just go to our website, go down to the drop-down menu, Investor, and it'll be right there, Investor Summit. So I'm excited. This is our first shot at it. So please come out to San Diego if you're out of the area. Put that date aside, come on out and enjoy a day in San Diego. All right, so we talked about the mouse pad promotion. So what is the mouse pad promotion? If you invest, add to your existing account or open a new account and invest, we're going to send you the TaliMar Financial mouse pad. I was kind of laughing. I feel like the mouse pad is the least changed out thing in your house. I have the same mouse pad as I've had 5 years ago on my desk. So what we want you to do is swap it out with a brand new TaliMar Financial mouse pad. If you invest in Q1 2025, we are going to send you the TaliMar Financial mouse pad. So here's the promotion. Invest, you get the mouse pad. We do have limited amount of mouse pads. I think I ordered 100 of them. So being that we have about an average of 20 to 30 investments every month, that should be sufficient for us to cover all of the investments coming in Q1, but it is while supplies last that we're going to run this promotion. If you have any questions, reach out to my investor relations team. All right, servicing fee change. This is what I want to talk about. Our loan servicing fee. So currently we charge the fund a servicing fee of 1.15%. That essentially covers the overhead of doing the servicing of the fund, as well as investor relations as well. Due to the increase in the cost of servicing, as well as covering the cost of the investor count that we have, we're going to increase that by 0.1%. So from 1.15 to 1.25%. Essentially what that means is that if our average yield for the fund came in at the end of the year at 9.55%, if we applied this new figure, you'd be at 1.45%. So if you have any questions on why we're changing the fee, feel free to reach out to my team, and we'd be more than happy to explain that. Investment process. A lot of questions about, hey, Brock, how do I get invested in the fund? I hear a lot of my friends, family, other trusted investors are investing in the mortgage fund. How do I get started? The process is really simple. It's just kind of 4 major steps. Number one, as you all know, you need to be an accredited investor. So you have to have a net worth of $1 million or greater exclusive of your primary residence. If you have any questions about that, again, feel free to reach out to my investor relations team. But step one, submit new investor account form. We'll provide it to you online. Very simple, takes about 10 minutes to complete. Once we receive that form, we're going to open up an account for you. We'll then have you complete the accreditation process. So you can either submit a letter from your CPA verifying that you are an accredited investor. You can show us an asset statement of $1 million or greater. Or if you make over $250,000 as a single person or $300,000 as a married person, that'll also get you accredited. Once you're done doing the accreditation, you'll sign the subscription agreement, you'll submit your funds, and away you go. And one of the great things about investing in the mortgage fund is, number one, you can choose how much you invest day one. So unlike trustees, where you're kind of relegated to the amount of that trustee investment, in the mortgage fund, you can decide how much you invest. And the best thing then is that you can add to that investment. So unlike trustees, where you kind of, when you invest, that's all you're going to be investing in, you can always add more to your exposure to the mortgage fund. So if you have any questions about investing, obviously, again, reach out to my investor relations team. You can also select the Invest tab on the website, and there is the application right there on the website for you. So with that, I am going to wrap it up. Say, number one, thank you very much for listening to our January investor update. I'm excited about what January or 2025 has to offer. We have some big initiatives within the organization that'll help us grow more effectively and efficiently. Also, another initiative is to do more investor outreach. So we want to meet you out in your area and talk mortgage fund. If you ever have any questions about the mortgage fund, or feel free, any questions, feel free to reach out to me or my team. Our contact information is on the screen, or you can reach us at invest@TalimarFinancial.com. Again, thank you for listening, and I look forward to hearing from you.